So welcome to the third of our ESG webinar series, How Can You Fully Integrate ESG? Firstly, a bit of housekeeping. Can please all of the panelists put themselves on mute when not speaking? Attendees, please feel free to use the Q&A function for questions you may have at the end. Please don't use the chat function for that purpose. A quick intro from me. My name is Emily Eyre. I'm MD of BRUIN Financial. BRUIN Financial is an award-winning financial services specialist recruitment agency. We've been really pleased with the success of our webinar series so far. We've gained coverage in Investment Week just last week for the survey that we ran, and we've also been very pleased with our partnership on this with the CFA. In the interest of time, I'm now going to hand over to one of my colleagues, Georgina Sell. Thank you, Georgie, for your incredible commitment to this, as well as all of the wider BRUIN team who've helped to support this. Handing over to you, Georgie. Thank you, and I hope you enjoy today.
Thanks, Emily. And thank you, everyone, for joining us today for the third of our ESG webinars. And well done to those of you who've managed to make all three so far. I hope you will be coming to the next two as well. So ESG integration has shot up company agendas, but many firms and individuals are struggling with the scale of the challenge. I was amazed to learn from a recent KPMG report that most UK businesses have no fully fledged plan in place to tackle climate change and other ESG related risks, despite more than 80% saying that this issue is being actively discussed and that it's important to them. Whatever role you have within the investment space, or even if you're just relatively new to ESG and interested in the subject, we hope that you will come away from our webinar today with some ideas around how you can successfully integrate ESG. It's been said that the pandemic was to some extent a dress rehearsal for the upcoming climate crisis. There's no doubt that it's exposed both strengths and weaknesses of businesses throughout the UK. It's been a huge impetus for boardroom discussions on environmental issues. And at the same time, there's been a surge of interest in social issues. It's a shame that it's taken a global pandemic for us to really see the effects of wealth inequality, poor living, and health conditions. But we're at risk of making environmental and social issues worse if we don't do better to bring about a more widely integrated approach to ESG. This would have multiple benefits for our economy and would have a significant human impact. It would be extremely powerful. So personally, I'm really delighted that we've managed to get such a great panel together today to brainstorm some positive solutions. And I'm excited to introduce them to you. And so first up, we've got Lisa Bowling. Lisa, give us a wave. So Lisa is Head of Sustainability and ESG Research at Impax Asset Management. Impax manage circa about 20 billion globally, and are specialised in investments that enable or benefit from a transition to a more sustainable economy. Lisa's background is a combination of financial and sustainability related work, including investment management at Goldman Sachs before joining Impax. And next up, we've got Andrew Watson. Andrew, would you mind giving us a little wave so everyone can see who you are? Thank you. So Andrew Watson is one of the founders of Rethinking Capital, a community of experts in intangible assets. Rethinking Capital will shortly publish a normative accounting standard for intangibles and impact in collaboration with the IWAI at Harvard Business School. Normative accounting is being positioned as the bridge between non-financial and IFRS reporting. And next, we've got Hortense Boy. Hi, Hortense. Hortense is Director of Sustainability Research at Morningstar and is responsible for their EMEA and APAC regions. She joined Morningstar as a senior ETF analyst over 10 years ago, and prior to that, she was a journalist at Bloomberg. She's written a number of articles featured in the Financial Times and other well-known publications. And we have James Ghaffari. Hi, James. James is Director of B Corp certification at B Lab UK. The B Lab movement is transforming the global economy to benefit all people, communities, and the planet. They're a leader in economic systems change, and they create standards, policies, and tools for businesses. They legally certify companies known as B Corps, and their community includes over 3,500 B Corps in 20 countries around the world. And finally, Thora Frost. Good afternoon, Thora. So Thora is currently a senior manager in the green finance team at Carbon Trust. Carbon Trust are a non-for-dividend environmental consultancy and expert partner for businesses, governments, and organizations around the world, supporting them in realizing ambitious plans for a low-carbon future. Prior to this, Thora has been an economic advisor for the UK and Icelandic government. So I'd like to start with you, Lisa, and I've got a couple of questions actually, but keen to just kick off with the first one. So obviously, since Impacts have received top PRI scores across private equity, listed equities and fixed income, I'm extremely interested to hear how you think firms can fully integrate ESG.
Thanks, Georgina. Kind words. I would say, first of all, that it is really a journey, this whole work around ESG integration. And I really think it should be viewed as one. It takes time and can always be improved and deepened over time as well. But a few things that have worked at the Impacts, in my view, would be the sort of the way we recruit. So for many years, we have been focusing on recruitment, really focusing on candidates that have both an interest and experience both in sort of ESG, sustainability, and financial work and aspects. It becomes much easier to integrate when there is a good understanding already of these aspects, and you know, sort of you don't have to convince people about the sort of usefulness of this. And we have also completely on purpose avoided having a separate ESG team. Instead, we have the lead analysts of the companies that cover our companies, do both the financial and ESG analysis work, but also the engagement. And my role there is really one of coordinating this work and being a sounding board and developing the methodologies around ESG analysis further. But I also think it's absolutely key to sort of have continuous training within the team and ensuring the team is up to speed with emerging issues. And there really are lots of emerging issues all the time. It's a fast-moving space. What also has been quite a good one is to have sort of the champions in the team who are exploring continuously new ways, for example, of using ESG metrics in financial models and have the sort of innovation type work going on. But it is also important to have ESG and engagement, you know, as key features of everyone in the investment team in their appraisals and their performance reviews. That's when it really starts mattering.
Great. And how do you think successfully integrating ESG has benefited Impacts?
Yeah, I think it's absolutely been very beneficial. And you know, the obvious thing is that we do know more about our companies and their character, their quality, and how they risk manage and how well they do that. And I think also with looking at this from an ESG perspective as well, very strongly, and giving our proprietary scoring for ESG every year also gives a good sense of companies' direction of travel. And this is really much relating to their quality and resilience over time. And we use ESG as a signal of that. I also think that having the lead analysts assess material risks, material sustainability risk is really good, because they actually are the ones who really know the companies in and out, and do know exactly how the companies manufacture, what exactly they do, where the manufacturing is taking place, where the sort of supply chains, etc., are. So it's incredibly useful to have the real company experts assess materiality, for instance. What we have also found is that when we use both financial and ESG information in combination, you get very interesting sort of signals and information. And we found that sometimes when things, for instance, start going wrong in a company, the sort of ESG aspects can, in some instances, be almost like a bit of a canary in the coal mine for these companies. And we have then seen that first something happens perhaps in the sort of ESG space, and then you might have at the same time perhaps margin pressure. You might have some change in the management team. Then you might have a very surprising M&A transaction, etc. And all these things are going on at the same time. I think those are incredibly interesting pieces of the puzzle and interesting pieces of information really in combination. But also, finally, just to say that we have also found that as part of our ESG analysis and the scoring, we have found that those companies that have higher ESG quality have consistently outperformed those that have weaker scores. So there is definitely something the market is also understanding and appreciating about these companies with higher ESG quality.
Great, thank you, Lisa. And I mean, I've heard that the EU has massively stepped up regulatory intervention to ensure a more rapid transition to a low carbon economy and to clamp down on greenwashing. So do you know the time frame associated with these EU regulations, and how do you think that they will impact organisations?
Yes, probably a few minutes is not quite enough to go through all the detail here, but the sort of very high level comments would probably be that indeed very, very large interventions are on their way, both for corporates, but also very much for financial market actors and investors. You know, really the sort of motivation here is, of course, around, as you're saying, reducing greenwash and increasing transparency, but also about stronger definitions around what is actually, you know, sustainable, what is green, and, you know, aiding. The idea, of course, is to aid more allocation of capital towards these areas. But looking at the sort of probably three elements I wanted to very quickly highlight in terms of these regulations. So the first one, really, the EU Green Taxonomy, which will be in place on the 1st of January 2022, relating to its sort of first 2 out of 6 green categories that it's taking into consideration. And at that stage, sustainable funds will need to measure and report their percentage allocation of green activities. There is clearly an issue of data availability, and I'll get to that in a few moments again. The second one is the SFRD, or the Sustainable Financial Reporting Directive, which investment firms and also their underlying portfolio companies will the investment manager need to report on a very broad set of ESG data, lots of metrics, up to 34 of them. And this starts at a higher level in March 21, but the detailed portfolio level and company level reporting will be at the end of 2021. And finally, in terms of the sort of corporates, there is also the Non-Financial Reporting Directive, which is a regulation for larger European companies to disclose more detailed ESG data. And the idea here is to, of course, provide more data for the EU Green Taxonomy and the SFRD, but there is a timing gap of at least 6 months, we think, versus the sort of EU Green Taxonomy. So a really major undertaking for investors, but also companies, and we need to prepare early. There will definitely be challenges with data availability, and also the fact that all these regs are sort of happening slightly at the same time, and, you know, some data or timing gaps as well. So quite a challenge.
And are there any other important kind of reporting standards or regulations that you think may impact the investment industry?
So I think it's been said that there's more than 300 different sort of standards and frameworks, which is a worry in itself, I think. But really the one I'd like to highlight is probably the TCFD, so the Task Force on Climate-Related Financial Reporting and Disclosure. So why do I think this is very important and influential is that I think it's so important that it highlights the governance aspects, but also the sort of strategic aspects of risks. I think these are often overlooked despite being so very fundamental. And the focus is always so heavily on metrics and data, which are also important. But I think that sort of aspect of you know, responsibility, accountability, and governance, as well as something being really deeply embedded into a company's strategic focus, is key there. And it is interesting to see that there are now many sort of projects underway, for example, within the aspects of biodiversity and water, to do, you know, similar type TCFD frameworks on, you know, based on that same type of framework.
Great. Thank you, Lisa. And Hortense, I know there's been a lot of controversy surrounding ESG data, but we know that data is extremely important to aid ESG analysis and sustainable investing. So how do you think improvements in this area are developing?
Yeah, so data is, I think, the holy grail in sustainable investing, and getting reliable ESG data is certainly a challenge for investors and asset managers. Given that much ESG disclosure is still voluntary, not every company discloses ESG information for a start, and those that tend to disclose information tend to be the larger companies, because they have the resources to do so. So they tend to focus disclosure actually on positive information. So there is some greenwashing going on there. Many companies have taken steps to voluntarily disclose more, or to voluntarily audit or review the information that they disclose, but there's still a lack of commonly accepted audit and review process for ESG data. Now, as Lisa just mentioned, there are already some organizations that have developed standards. So she mentioned it's TCFD, but there's also SASB, Sustainability Accounting Standard Board, which focuses on financially material issues, which are the issues that most investors should focus on. And but there are others, there's GRI, and which tends to focus on non-financial materiality. But I mean, the reality is, I think now more companies are now using these standards, which is a good thing, and they're disclosing also more ESG data. So that helps provide greater transparency and comparability for investors. One thing that investors now also tend to do is, and especially to make sense of the data and get a better understanding of the companies they want to invest in, is to engage. Engagement comes alongside ESG data, and has become equally important to investors. So through engagement with companies, investors get a more forward-looking view of the sustainability profile of the companies. Investors.
Wow, I think we may have temporarily lost Hortense. Looks like she's frozen, so we may have to move on to another question. So Andrew, I know sort of Hortense has referred to this a little bit in what she was saying, but I mean, how do you think that capitalism has got into this mess in the first place?
Thanks, Georgie. I probably thought to start actually by saying, imagine me like a man in a cave that hasn't been let out for about 20 years, trying to talk about intangibles. Nobody listening for around about 20 years. And then actually what we've done is come from intangibles into accounting for intangibles and into the whole area of sustainability and ESG. And I'm a lawyer by background. And I walk in this area and go, oh my, this is complicated. Nobody has a common language. People use the same words to mean different things and vice versa. So we come at this in a really sort of simple way. It's based on two books. One's called Futuromics by my colleague, Robert McGarvey, with a V. And the other is a book actually we just found recently called The Reckoning by Jacob Soll. And Robert's book talks about 3 transitions during history, where there's been a transition in the engine of value creation from one asset class to another asset class. And every time a transition takes place, the same pattern repeats, but the economy changes. And then all of its derivative systems to manage the economy, so the general theory of economics, accounting, reporting, etc., take a while to adapt. So here what we see in this third time around is a transition from the industrial economy to an intangible economy. That's the way we see it. But we're still using neoclassical economics and the theory of scarcity to manage the economy. And we're also using accounting, which is really designed for a very different era. So it's really interesting when you take the balance sheet out of the equation, right? So what am I now? I'm 50, what am I? I think I'm 56. I don't remember in the days where there was a balance sheet. But now, actually, if you look at the balance sheet of most oil companies, you don't see its intangible assets. They all get written off. And you don't see people properly recognizing intangible liabilities like climate risk. So Lisa mentioned TCFD. Within there is some brilliant thinking around recognizing provisions, contingent liabilities, which I'll talk about. But essentially what we've created with that balance sheet is a belief system which is upside down. So we see it like set 2 at school, where set 1, every child actually behaves well, everybody drags themselves on in terms of performance, and set 3 you get the opposite. In set 2 you've got a combination of children trying to get to set 1 and children who are trying equally hard to get down to set 3. And the worst behaved children do so without consequences and they get rewarded for bad behaviors, and the best behaved children receive no benefit and are often punished for their first mistake. It's just totally upside down. Now, apparently we make 10,000 decisions every single day, most of which are unconscious. And in our view, most of them are made at the moment with that belief system, which is upside down. So our work then is to work out how do you correct the belief system. I hope that made sense.
It did make a lot of sense. Thanks, Andrew. And I mean, sometimes the rate of change doesn't feel fast enough, and it can actually feel quite overwhelming at times. So amongst all of the complexity, do you think that there could be a simple way out, a simple solution?
Yeah, I mean, I was there at the start of the embankment program, which now has become the sort of 22, 21 metrics that have just been published by WEF and the Big Four. And actually the assumption made right at the start of that program was that accounting couldn't solve the problem. And therefore we got into non-financial from day one. I'm not an accountant, I'm a lawyer. And for us, actually, we see it very simply. First of all, we got to rethink economics. I know that might sound like a big task, but actually when we realize what's creating value and we look at what's expected now in a world which has a normative set of beliefs. In other words, we know what good looks like. We know what normative should look like in terms of behavioral standards. And we're seeing that coming through from youth movements in particular. We think this is all about updating accounting. Now, that's not going to happen through the Accounting Standard Board. It's too slow. So we've created this concept of normative accounting, which, as you said before, Georgie, is meant to be the bridge between non-financial and IFRS reporting. It can be done by a company in its entirety, or it can be done per scenario. So in other words, actually look at climate risk. It can be done actually on a climate risk scenario by the company from the outside. Essentially what you're creating is a standard for conforming with social norms.
Okay, because that leads me on very nicely to my next question, which was, do you think that sustainability can be integrated into mainstream accounting so that every firm in every industry is held accountable to the same standards?
I do. I think technically it's possible. I think it's a question of getting people to innovate with this sort of area. I think Lisa made a great point before, though, around TCFD. And actually, we, again, we're fairly new to this area, but you pick up TCFD guidelines and sorry, you can tell how boring I am about this. Pages 36, 37 say areas for further research, accounting. And it refers specifically to IS 36 and 37. 37 is brilliant, actually. It's a really, really well constructed standard. It talks about constructive obligations, in other words, expectations based on companies' statements. So imagine any company right now stating they're going to move to be BP, for example, a green energy pioneer. As far as we're concerned, that is a statement that we can actually tie a legal obligation to. But it's also, what's really beautiful about the standard is it talks about the identity of the person to whom the obligation is owed does not need to be known. It can be the public at large. So you're getting into these, again, as a lawyer, you're getting into, first of all, you say, why aren't companies already disclosing these, even in notes? There's an S&P article coming out shortly, raising exactly this point. Why even in the notes aren't we disclosing these liabilities? And yeah, so I think all the materials are there, and I guess I'll say also, we're not making stuff up. We're using GAAP, we're using double entry bookkeeping, and we're informed by all the existing standards. So as far as we're concerned, all the materials are there, but it's a question of building a community. And that's what we're doing now in bringing companies on board, some investors, and really trying to just practice and experiment.
And how important a role do you think that capital markets play in helping to further progress on environmental, social governance issues?
Yeah, I mean, this isn't my thinking. This comes from Connor Kehoe at the ILC. He thinks there are 4 levers you've got to pull, one of which is capital markets and investors. I think that's right. It would make sense. In the previous transitions in the economy, investors are always the ones that actually drive change. They're always the ones that either are the biggest beneficiaries or the biggest losers, depending on which side of history you're on. So yeah, absolutely, we believe that investors are critical and vital. I'll probably only make one more point, which is as well as accounting, we're also looking at normative governance of reputation. So from an intangibles point of view, reputation is fascinating because all intangibles are duality. Sorry, I'm talking with my hands right now. I always do this. All intangibles are duality in the fact they're either a value creating asset or they're a value destroying liability, depending on the quality of their management. And reputation is the one that swings, the greatest degree between a Weinstein type reputation or, one of my favorite companies we work with is Novo Nordisk. And actually what you see is some organizations through their decisions have made their reputation into a strategic asset. Some actually, their reputation is vulnerable to catastrophic failure. So we've developed the whole theory of reputation as to how reputation should be governed. And of course, what would be brilliant and what we'd love to do is talk to investors about how can you get organizations to think this way? Are there groups of investors who could actually start to say to companies, this is a logical way to think about how you manage your reputation. We'd like you to start applying this in a standard way.
Thanks, Andrew. That's really helpful. And I can see we've got Hortense back on the line now. So we'll just finish off with a couple of questions, if that's all right. There was actually one thing that I was quite keen to ask you about, Hortense, because I read a Financial Times article recently where I think you mentioned that some of the risks posed by assets associated with fossil fuel companies, basically I was just quite interested to hear how you think divestment from areas such as oil and gas can help the transition to a low carbon economy.
Yeah, I think fossil fuels are definitely, as fossil fuel company are definitely a polarizing topic. So, I mean, the reality is now there is this growing fossil fuel divestment movement among both institutional and retail investors, and they may want to divest for slightly different reasons. But I think the main reason is risk. Climate change poses risks to an investment portfolio. There is physical risk, there is regulatory risk, reputational risk, which was just talked about, stranded asset risk, and many others. And some investors simply want to avoid these risks, some of which may materialize in the short term, while others will materialize later in the future. So that's very difficult also to determine, but they know that they want to get rid of this risk. Now, can divestment from oil and gas help the transition to a low carbon economy? I think, first of all, it's important to acknowledge that there are investors out there who care more about reducing risk than helping the transition to a low carbon economy. Now, there are also investors who may want to do both. So are those two compatible? Yes, you can divest from fossil fuel companies to invest your money in companies who you think have a better future because they are in the renewable energy business. Now, I know there is also the argument that if you care about the whole system, you should stay invested in these companies and engage with them, influence them, and help them transition. That's a possibility too. But there are companies that are not moving fast enough or are not receptive to engagement. So investors have to weigh the risks. Staying invested in companies with very uncertain futures can be a risky strategy.
And what do you think about the argument that divestment could make things worse if fossil fuel assets actually end up in the hands of private owners who aren't regulated in the same way that oil majors are?
Well, that's an argument. However, these private investors, they also need financing. from banks, right? And we know that banks are becoming stricter about their lending conditions. And when it comes to climate risk, even the European Central Bank the other day said that it is now considering the idea of using climate risk in its bond purchase program. And the other thing is also that private investors they also need to think about when and to whom and at what price they're going to sell their investments. They're not going to keep it forever. And this is what investors do, they buy and sell. And they should be fully aware that, and I'm sure they are, that dirty assets will not be an easy sell in a market where everybody is going green.
Yeah, no, thank you, Hortense. And James, I read a report recently which said that 70% of large businesses say that sustainability is a growing priority as a result of COVID. Why do you think that is?
Yeah, thanks. I think it's something that we've seen here at BLab UK and with the B Corp movement. Certainly over the last 6 months since COVID, we've seen kind of a doubling of all of our key indicators of engagement, which has been fantastic to see that companies are really now engaging with this idea of sustainability. And I think there's a couple of reasons behind this. I think the idea of sustainability has moved significantly on in the last couple of years. The idea of CSR kind of that we had, corporate social responsibility that we had maybe a decade ago, was this idea that it was a corporate giving program that kind of sat at the edge of your balance sheet. And so maybe when we saw the 2008 financial crisis, obviously orders of magnitude less severe than what we're going through right now, we saw kind of cost-cutting measures from companies, and to be honest, CSR was usually the first thing to go. But what I've seen over the last kind of couple of years is a maturing of this narrative around sustainability that has been created by popular protest, specifically around the environment, but also around racial equity, a growing maturity of consumers who are demanding that their products are, good products and they're buying from good companies. But also the increased kind of financial attractiveness of ESG and ESG funds and that kind of thing as well. So the idea of sustainability having to be at the core of a company's operations has really driven what I think is a lot of these companies looking at what's happening right now and looking at this idea of sustainability and thinking, maybe that's our mechanism through this crisis. Maybe we need to actually look at the idea of being a more sustainable company and the idea that actually over the long term, this can help us ride out crises. Because if we're honest, and we understand the consequences of the climate crisis, the crisis that we're going through right now is almost the small crisis before the kind of the several other crises that could be coming down the line. And so the idea of being a more resilient company that is able to kind of ride out these different kind of this growingly unpredictable and uncertain future is probably quite attractive, and that's probably what the companies are leaning into. And I think the other mechanism is just that if you have been severely impacted as a company, this idea of building back better is maybe quite appealing, because you've maybe run your business, or if you're an investor, your portfolio in a certain way just based on the way you've always run it. And so if you're severely impacted, you can really look at it and say, well, actually, we're going to do things intentionally going forward. And those things are going to be in line with my values rather than the way in which we've run it before. So maybe those two things have really what's been behind this growth in engagement with sustainability.
Thanks, James. And it's been said that B Corp is the new era of business for people, planet, and profit. How can B Corp help to advance your ESG journey and help towards a COVID business recovery?
Yeah, well, that would be great. I'd love that if it was the new era. I think, what we'd love to do is for more companies to behave in the same way as B Corps. But I think the way in which kind of engaging with B Corp could be, advantageous for an ESG journey is two ways really. And I think the first one is through using our impact measurement framework. And so we have an impact assessment called the B Impact Assessment Online. And it essentially is a way in which you can manage and measure your impact, or the impact of your business on its key stakeholders, those stakeholders being those groups that are affected by or affect your business. So your customers, your suppliers, your employees, the environment, the communities at large. And what this impact assessment does is it's a very challenging and comprehensive kind of tool that asks, 150 to 200 questions about your business. And it allows you then to benchmark your performance on environmental and social standards against companies of your size and your sector. But it also gives you loads of ideas of how to increase and improve your sustainability and your relationship with those key stakeholders. And that's a completely kind of free and confidential tool. So that's the first thing. The second thing, which is really significant, I think, is the B Corp legal change. And this is the other way in which companies, the second kind of condition for companies that want to become B Corps, is that all B Corps in the UK have made a legal change, an amendment to their Articles of Association, to say that they will consider the impact of their decisions on all stakeholders and not just on shareholders. And basically, this is the idea of putting, as we said before, people and planet alongside profit. And we think this is just a good way to run a business for the long term in the 21st century, not be driven by short-term shareholder maximization impetus, but actually to be able to take into account all of the kind of liabilities and all of the kind of consequences of your decisions, like what Andrew touched on. I thought that was really interesting about the intangible liabilities. To think about all of those things when you're making those key decisions in the boardroom. It can't just be, one metric for what success means in business, which is, maximizing shareholder value. It needs to be much, much more broad, and that can make you more successful as a company. And beyond that, we have a very, very supportive and dynamic community all around the world, and we have several kind of working groups, including an investor working group. So Montanaro Asset Management, Towerbrook, they are both B Corps. They're quite mainstream, that you may have heard of. We also have kind of several net zero commitments that we've just recently announced, and we put on a lot of kind of spaces for community learning within the B Corp movement here in the UK.
Great. And how can you assess your impact as an organisation more generally?
I mean, I think impact is often confined to the idea of the environment, which I think is extremely important. The most important thing that we have to do really is stay within the means of the planet. But the other side of that kind of mantra is meeting the needs of humanity within the means of the planet. And so it's important not to forget the kind of people side of sustainability as well. And so the idea of when you are thinking about sustainability and impact, it doesn't just have to be, science-based targets and scope 1, 2, and 3 greenhouse gas emissions, which it should be. It can also be, how you engage with your employees, which I think now is a massively important thing. Everyone's working from home. We're in the UK about to go into 6 months of lockdown winter, which I don't think anyone's looking forward to. And so it's, never has it been more important to think about those key relationships that you have with your employees. And so it's really kind of identifying those stakeholders, as I said, those groups of people that are infected by or affect your business, your customers, your suppliers, your employees, the environment. Think about them, try to kind of measure and manage your impact on them, which I've said you can do through the B impact assessment, and then set targets, identify the problem areas that you have in your business. Maybe you haven't given enough thought to your diversity and inclusion and representation kind of goals within hiring of people in your organization. Identify the problem areas, galvanize your workforce behind it, which they will really, really engage your people around, and make the change essentially. So that's really what I would advise.
Thanks, James. And Thora, I'm interested to hear from an investment perspective how you would define impact. When I think of impact, I associate it with someone crazy like Elon Musk, who's revolutionized the modern world. But I'm interested to hear how impact investment works alongside ESG and, you know, what's the difference essentially?
Yeah, absolutely. So I guess in some way you could think about impact investment as and kind of escalation beyond ESG investment, being a bit more climate ambitious in that sense and adding into other parts of ESG as well. So I think we would talk about impact investment as an investment made with the intention to generate positive, measurable social and environmental impact alongside financial returns. So that's how you would think about it. So measurable, positive, social and environmental impact. How it works alongside ESG is that you have to also think about not just how whatever product or service you're providing to the world and how that has an impact positively, but also how that's generated. So is there a footprint of the organization that you need to think about beyond that? So I think we have to, for a whole holistic approach in the whole story, you have to think about, for example, if you produce renewable energy, which is having a positive impact on the environment because it avoids emission from fossil fuels, for example, that still has a carbon footprint. So knowing that and understanding that is key. So that then you have a holistic view of that as well.
What can organizations do to commit to carbon neutrality? I mean, we've seen some organizations even doubling the pace of the Paris Agreement. So are there any particular tips that you could give?
I think start getting your own house in order to start with. So look at your own carbon footprint, and you might want to offset that and become carbon neutral. Maybe that's your first step. So understanding your emissions, maybe just your organization to start with, and then moving on to your value chain. And you could buy offset and become carbon neutral, and that's a positive step. But going beyond that, I think you would want to look at is setting long-term targets aligned with the Paris Agreement. So setting a science-based target. So aligning your organization to a low carbon world. And that means potentially setting a net zero target, which means aligning your operations and your organization to the Paris Agreement, and also capturing any carbon that's left out of the atmosphere by a certain time frame. Maybe that's 2040 or 2050. A lot of them UK has set a net zero target for 2050 as a guideline. For a financial institution, it's a bit more trickier because that means you have to look at your investment portfolio. It's about your financed emissions. So that's part of your value chain. So as a financial organization, I would recommend you start looking at your own operations to start with. That's fairly simple, your offices, and set a target around that, and then move really quite quickly into looking at your investment portfolio, looking where your hotspot lies, thinking about strategy around that, and thinking about setting targets. And we've seen guidelines coming up. Recently, the Science Based Target Initiative set forth guidelines around how financial institutions should set science-based target for their portfolios. That's in a pilot phase at the moment. We saw the Institutional Investors Group for Climate Change put out a net zero investment framework, which gives guidelines for investors how to align their portfolios with a Paris world or a net zero alignment, which looks at setting targets around how much of your asset under management are invested in corporates that are Paris aligned. And that you can look at benchmarks like Climate Action 100, putting a benchmark around what is a Paris aligned corporate. That's one bucket. And the other bucket is kind of more the green side, climate solutions, setting targets around how much of your asset under management are investing in green climate solutions. So that would be my kind of advice in that sense.
Thanks, Zora. And I mean, David Attenborough recently warned of the collapse of our civilizations and much of the natural world, and that climate change and biodiversity loss is the chief threat to human life. So I'm really interested to hear where you think investors can make a difference in terms of biodiversity finance and why you think it's important.
I think it's really important to look at the holistic picture, not just focus on one part of it. And in that sense, what I see as a really interesting development is the EU taxonomy, which is an attempt to understand what is green or sustainable, but also incorporating all these other areas like biodiversity. So there will be developed criteria so you can claim a sustainable investment, but also that you've done no significant harm to the other areas. So I think we are moving to a world where investments that are green also have to be shown not to have a harm on other areas like biodiversity. And I think that's definitely where the market's going.
And we've all been very excited to hear about China's commitment to net zero carbon. Would you mind telling us about the recent Carbon Trust project to introduce green technology to China?
Yeah, absolutely. So we have an office in Beijing. We've had that office for quite some time now. But this particular project, we are working with the European Bank for Reconstruction and Development, EBRD, and we're helping them expand their green technology selector, GTS, sorry, Green Technology Selector. And that's based on our work in the UK, where we've been designing and managing the UK's energy technology list. I don't know, you could probably describe it as a online shopping style platform that connects vendors of the best green technology with forward-thinking financial institutions, businesses and homeowners. So in a way, it's about understanding what is the green technology and who has provided that in each country. And the idea is to expand that to other countries beyond China going forward. And it really kind of supports the green finance element of understanding how can I design a loan that has potentially preferential rates for energy efficiency projects. I need to understand what are the best technologies out there so I can provide that loan, and that list is supporting that whole transaction happening.
Thanks, Laura. And I think we're going to move over to Emily now for opening up questions to the audience in the Q&A.
Great, thanks, Georgie. So probably a nice, easy one to start off with for James. Can you tell us what the B in B Corp stands for?
Yeah, I wish that was actually an easy one to answer. It actually stands for Benefit Corporation. So B Corp was launched in the US. When it was launched in the US, they have, well, and ongoing, they have been fighting for a separate legal or separate company structure for companies that want to operate in this way, like a B Corp. And they've won this legislation in, I think, 35 states now. It's also been won in several other countries as well. So it kind of stands for a separate legal, separate company structure that's available in the US. In the UK, as I mentioned, we make an amendment to the Articles of Association because the Companies Act in the UK is actually quite flexible, and it already has contingencies for stakeholder interests in it. And so we just take that and raise that up within a company's articles to make sure that they are able to be driven by the interests of all of their stakeholders and not just their shareholders.
Right, thank you, makes sense. And just further to that, can B Corp organisations perhaps join forces with other groups of organisations such as Race to Zero to help accelerate progress?
Yeah, absolutely. Like we're always very keen to work with other organisations, either kind of down or up above, and I'll explain that. So downwards is that there are several kind of single variable certifications, so things like fair trade and organic and vegan and BRIAM, which is like environmental standards for buildings, that we all integrate into our impact assessment. And then working with organizations that are in the same space generally, we've actually just come to the end of a year-long program with the UN Global Compact, where we've taken the SDGs and we've created what's called an SDG Action Manager. So if you search for SDG Action Manager, you can actually answer several questions about different SDGs that are relevant to your company and dive deep into your impact against those SDGs, the Sustainable Development Goals, and see where your kind of key risks are, but also where you're making positive impact against those. Finally, the other point is that B Lab in general is part of something called Imperative 21, which is a group of companies that are organizations in this same space that are working towards a transition to a more kind of stakeholder governance model of doing business.
Great, thank you. Andrew, would you mind just repeating the books that you mentioned previously?
It must be my Geordie accent getting in the way of actually of talking properly. Yeah, first one is called Futuromics. So future and then without the E and then omics. This is by Robert McGarvey. He's my founder in Rethinking Capital. It's a really easy book to read. It's written as a series of letters from a grandfather to a granddaughter who's studying economics and doesn't understand why it doesn't connect with the real world. And it has a beautiful ending where basically we look back from 2050 and we look at all the things we changed between 2020 and 2050 that actually gave rise to this new economy. So it's a really easy read, one of those ones you could read in a couple of hours. And then the other one is more technical. It's about double entry bookkeeping by Jacob Soll, S-O-L-L. He's a professor from USC. Great guy. Robert and Jacob both reach the same conclusion. If we get double entry bookkeeping right, we will create a new renaissance. I love the story because if nothing else, it's a lovely narrative for where we are right now. But they're both passionately of the view that actually, if we just do some simple steps in the right order and learn from history, there will be a 21st century renaissance. Who knows?
That's good. Thank you. Andrew, whilst we've got you here as well, are there any instances where integrating sustainability into mainstream accounting standards wouldn't work, in your opinion?
Well, we haven't found any so far, Emily. And as I say, we've just developed the standard in collaboration with George Serafin's team at Harvard. And we're experimenting with it right now. So we've got one pilot underway. We've got 2 more going to begin before Christmas. And then we intend to do an experiment. I'm going to call James afterwards, which we're calling 100 this budget cycle. And what we want organizations to do is to say, we've just allocated this amount of capital to the climate transition for next year. But let's look back and say, well, that assumes accounting treatment as it stands right now. In other words, you'll write off all your investments into intangibles, and I'll explain the relevance of that, as an expense, and therefore actually it's a short-term deterrent. What we do is we instead say, well, that's got to be investing into an asset. So the definition of an asset under the ISB conceptual framework is a resource controlled by the entity from which there is potential for future economic benefits. And so we believe that the social license is an asset. And so we reverse the polarity in decision making and say, rather than that being a cost on the income statement, it actually is growing equity on the balance sheet. So far, no, we haven't found any. But I'm no doubt we will come across some, including resistance from the accounting profession, who are going to hate that we're actually ripping up the rules and starting again on accounting.
Sure. Thank you. Hortense, when it comes to climate change, people often think we have a lot more time than we obviously do. Do you think more private sector innovation is needed now so that investment in these areas can follow suit?
Yes, I mean, it's no secret that the listed market is shrinking. The public market is shrinking while the private market is growing. More and more institutional investors are actually putting money into the private market, which is not easily accessible for private investors, for individual investors who want to save for retirement, at least for those ones. I mean, the advantage of private markets is that typically companies are closely held. So there are few shareholders of private companies. And so you could argue that if you have a few shareholders in each of those companies that are determined to make the business more sustainable, then they would pressure the business and they will achieve more and quicker than those listed companies that have a very diverse shareholder base, where asset management, held by so investors do not necessarily agree on what companies should do in terms of climate change, even if there is like a growing consensus that we should have more disclosure on climate risk. The speed at which this should be achieved there's no consensus there, and some investors are just happy to sit there and wait for the regulator to put more pressure on companies. Yeah, there is really this argument that, I mean, going back to what I was saying earlier, or what the question that was asked to me earlier, is that, well, if all those bad assets, dirty assets are going into private hands, then no one, will have no control over them. And you're going to have like this clean listed space and this dirty private space. And I do not believe this is going to happen, because we're talking about mostly the same type of investors. These are institutional investors with lots of money, and they will put exactly the same pressure on these companies. And you have banks, as I mentioned them as well. They will put pressure on private companies as well.
Mm-hmm. Yes, absolutely. And sort of, I suppose, related, and perhaps Lisa, you might want to take this one, is in terms of asset class, how do you think it is best to prioritize the focus of ESG integration by asset class?
Not sure it's a prioritization, really. I think it is something that needs to be done across all asset classes to have, better investments. But it is certainly a different type of approach and process for different asset classes. Of course, in the sort of ESG marketplace, the listed equity space has been leading on it, and I think it is partly because of easier disclosures and or availability of disclosures and sort of reporting, etc. But I think it's very key to prioritize ESG analysis across all asset classes. But again, it's quite a different set of approaches for all of them. Not a priority question.
Georgie, I think that's probably, we're close to running out of time, so we probably don't have any more questions, time for questions. Sorry, I'll hand back to you.
Thanks, Emily. Yeah, it seems we've run out of time, but thank you all very much for your participation today. And I mean, this conversation has brought into reality for me the complexity of environmental, social and governance issues that we face. It's clear that capital markets have a key role basically in helping to progress ESG issues. And this does start with integrating ESG into investment portfolios to deliver results with a sustainable focus. We've discovered that successful ESG integration, both internally and externally, can achieve financial returns for investors, and it can be beneficial for your shareholders and employees internally. It's basically just good business, and it should become the norm, not something that is just a fad. So COVID-19 could be a tipping point, or it could be a turning point. It could be a unique threat or a unique opportunity, making this the most critical decade ever. The next 10 years will determine whether we stand any chance of preventing the worst impacts of climate change and social inequality. We must move further and faster. It seems we can do this by advocating for ESG reporting standards such as TCFD, UNPRI, and the EU Sustainable Finance Regulations. But we can also help to change behaviours on the ground by using data from data providers to help with our investment decision making. And we can encourage organisations to change their articles of association, or we can integrate sustainability into mainstream accounting, or we can work with impact or environmental consultancies. Hopefully we can get back together at some point in the future and discuss progress in all of these avenues. And we'd like to thank our partner CFA for supporting our ESG webinar series, and a special thanks to our panel speakers today and to all that attended. We hope that you'll join us for our next ESG webinar, How Can You Prevent the Environment from Being Sacrificed, where we will explore different environmental solutions on November the 10th at 1 p.m. Thank you very much.